You might think numbers are numbers, right? Objective, straightforward, no room for debate.
Yeah, seems logical.
But what if I told you that even within a single unified company, the way internal costs are accounted for can radically change everything? Today, we're taking a deep dive into something called transfer pricing.
Right.
It's simply the price one department or division charges another part of the same company for goods or services.
Exactly, like an internal transaction.
Imagine Division A makes components and then transfers them to Division B. Division B adds more value, sells the final product to outside customers. That internal price Division A charges Division B. That's the transfer price.
And what's fascinating here, and why this isn't just some, minor accounting detail, is how those accounting figures get calculated. Think about marginal cost, just the cost of making one more item versus total absorption cost, which tries to spread all costs, like rent, across every item.
Different ways to count the same cost.
Exactly. Yeah. And they can be legitimately calculated in different ways. Each method can lead to a different, yet technically correct value. The right figure really depends on what you're trying to achieve.
Okay.
Transfer pricing gives us excellent examples of this coexistence of alternative legitimate views, basically showing how the way you crunch the numbers makes those figures a bit, subjective, kind of arbitrary even.
Arbitrary? How so?
Well, it means a division could look like a star performer getting investment when maybe its underlying economics aren't actually that strong, all because of how an internal price was set. Or the flip side, a really good unit might get starved of resources. It can lead to misconceptions, maybe even the wrong decisions entirely.
So our mission today is to unpack why these seemingly internal numbers are vitally important.
They really are.
Affecting everything from how employees get paid to where a company decides to invest, and ultimately whether the whole business actually succeeds.
Absolutely key.
So, okay, on the surface, the numbers look straightforward, right?
You'd think so.
If Division A makes components for $30, transfers them to Division B for $50, then B adds $20 in its own costs and sells for $90. The total group profit remains $40. That's $90 minus the $30 minus the $20. It doesn't matter what that internal $50 price tag is. Mathematically, yes, the group profit stays exactly the same.
Correct. For the group as a whole, mathematically.
But this is where the plot truly thickens.
Precisely. While a group profit might be mathematically constant on paper, the profound knock-on effects of changing that internal transfer price, they're enormous for how the divisions perform and what decisions they make.
Oh, yeah, like what kind of effects?
Well, for instance, think about performance evaluation. How a changed transfer price affects metrics like return on investment, ROI, or maybe residual income, RI.
Right.
That could actually lead head office to question a division's viability, maybe even think about closing it down. Then there's performance-related pay. It has a direct impact on employee pay packets and, morale. If people feel their bonuses or even their job security are unfairly hit by these internal prices, that's a problem.
So it's not just an accounting entry then. It feels like a strategic lever with a real human impact. It genuinely goes beyond just the numbers on a spreadsheet.
It absolutely does.
Yeah.
Imagine being a manager, told your division's failing, when actually it's just down to these sort of arbitrary internal numbers.
That'd be incredibly frustrating.
Definitely. A very high transfer price, for example, could make it literally impossible for the receiving division, Division B, to show a profit.
So what happens then?
It might push them to abandon that product line entirely, or maybe look to buy cheaper components from outside suppliers. Those are huge make, abandon, buy-in decisions.
Critical choices.
And think about motivation. If one division just can't make a profit because of a bad transfer price, its employees could be completely demotivated. Meanwhile, the other division might have an easy ride, maybe less incentive to be efficient.
Uneven playing field internally.
Exactly. And it doesn't stop there. Investment appraisal cash inflows from new projects are almost certainly affected by transfer prices. That influences critical capital investment decisions, the ones evaluated using net present value.
Big strategic stuff.
And if the divisions are in different countries, transfer prices dictate where profits are reported. That significantly affects the group's overall tax bill and how much profit can actually be sent back to head office.
Wow. Okay. So what you're saying is a number that seems purely internal can actually dictate a company's strategic moves, employee happiness, and even its global financial footprint.
That sums it up pretty well.
Which raises a really important question. What makes a good transfer price?
The million-dollar question. The ideal characteristics. Well, they're not easy to get right all at the same time, but they are crucial.
Okay, like what?
Firstly, it should preserve divisional autonomy. You want managers to feel empowered to run their division and maximize its profit without, too much interference from head office.
Makes sense. Let the managers manage.
Secondly, it absolutely must be perceived as fair. That's critical for performance reviews, investment decisions. Everyone involved needs to see the price as equitable.
Fairness is key for buy-in.
Thirdly, it needs to allow each division to actually make a profit. Profits are motivating, right? And they allow for positive performance measurement using things like ROI.
Right. Nobody wants to run a division that only makes losses on paper.
And finally, perhaps most importantly, it needs to encourage what we call goal congruence.
Goal congruence.
Yeah, meaning the decisions a division makes to maximize its own profit should also happen to maximize the group's profit.
So everyone pulling in the same direction.
Exactly. It implies that both the transferring division and the receiving division must genuinely want to trade with each other. Like two players on a sports team who know their individual success helps the whole team win.
That sounds like a tall order. It's like trying to make everyone happy and get the best result for the whole team. So how on earth do companies actually try to set these prices in practice?
Well, this sort of foundational concept is what we call the economic transfer price rule. It basically defines the sweet spot, the range where trading is good for both divisions and the group.
Okay, how does that work?
For the transferring division, let's call it Division A, the minimum price it should accept must be greater than or equal to its marginal cost of production.
The cost of making just one more unit.
Precisely. If Division A's marginal cost is, say, $18, then the transfer price has got to be at least $18. That way, Division A can make a contribution towards its other costs.
Got it. Minimum is $18. What about the maximum?
For the receiving division, Division B, the maximum price it can pay is linked to what we call its net marginal revenue.
Net marginal revenue, but break that down.
In simple terms, it's how much extra money Division B makes from selling the final product after it covers its own direct marginal costs.
Okay.
So Division B sells for $90 and has $10 in its own marginal costs. Its net marginal revenue is $80. So the transfer price can be no higher than $80.
Right. So the range is between $80 minimum for A and $80 maximum for B.
Exactly. And if the transfer price is set at, say, $50 neatly between that $18 and $80, then both divisions should find it worthwhile to trade. Division A makes a contribution, $50, $18, $32, and Division B makes a contribution too. $80 net marginal revenue, $50 transfer price equals $30.
Okay, that makes sense.
And this rule is pretty powerful because it essentially bakes in the correct economic decision for the whole group. It acts like a built-in stop loss for the company overall.
How so?
If the final selling price of the product drops too low, so low that the group can't make a positive contribution overall, then no workable transfer price will even be available within that rule.
Ah, okay. Example.
Sure. Let's say the group's total variable costs are $18 for Division A plus $10 for Division B, so $28 total. Now imagine the final selling price falls all the way down to $25.
Ouch, losing money.
Right. The group loses $3 on every unit, $25, $28. Now look at the rule. Division A's minimum is still $18, but Division B's maximum, its net marginal revenue, is now only $15. $25 final price, $10 its own cost.
So minimum $8, maximum $15.
There's no overlap. No price works for both. So no workable transfer price exists. And the rule correctly guides them not to make the trade, which is the right decision for the group.
Ever.
But if the final selling price was, say, $29.
Just above the group cost.
Exactly. The group makes $1 contribution, $20.
Okay.
Now, the minimum for A is $18. The maximum for B is $19, $29.
Ah, a tiny window.
A tiny window, yes. A viable transfer price has to be at least $18 and no more than $19. So a price like maybe $18.50 would work. Both divisions make a small contribution and the trade happens, which is good for the group.
What's fascinating here is how head office could, manipulate divisions into making those group optimizing choices just by setting a price within that valid range. It gives the impression of autonomy, doesn't it?
It can, yes, but
if managers feel manipulated, doesn't that just undermine the whole idea of autonomy we said was so important?
It's a very delicate balance, you're right. Because even within that valid range where you set the price dramatically alters how profitable each division looks.
Right. Set it high, Division A looks great. B struggles. Set it low, the opposite.
Precisely. The higher the transfer price, the better Division A looks, the worse Division B looks, and vice versa. This creates Well, plenty of scope for arguments, distortion, and just general dissatisfaction among managers.
I can imagine the arguments.
Oh, definitely. I recall working with a company where one division, let's call them the widgets team, was absolutely furious because their internal cost from the gizmos division was so high they felt they couldn't compete in their market.
Why was this happening?
Turns out the gizmos manager was really just focused on making his own division's profit look good on paper. He completely overlooked the ripple effect on the widgets team's morale and ultimately their market position.
Tunnel vision.
Exactly. Plus, this economic range we talked about, it's not static, it's dynamic, it's constantly changing as production costs fluctuate, as final selling prices change.
So it's hard to keep track of.
It can be incredibly difficult to manage in real time. And that complexity often leads management to prefer simpler, more stable rules for setting transfer prices. Even if, and this is the key trade-off, even if it risks making poorer overall decisions for the group sometimes.
Okay, so the ideal economic rule is powerful, but maybe too complex or politically charged day to day. What are these more practical approaches companies often use instead? What are the trade-offs they're making?
Right. One very common practical approach is setting the transfer price equal to the variable cost of the transferring division. So in our example, that would be $18.
Just the bare minimum cost to make one more.
Exactly. Now, the big advantage here is that this usually produces very good economic decisions for the group. It achieves that goal congruence we talked about.
How does it do that?
Because if Division B sees the component cost as $18 and adds its own $10 variable cost, its total marginal cost is $28, which is exactly the same as the group's marginal cost.
Ah, I see. So Division B's motivation to make profit by selling for more than $28 perfectly aligns with the group's goal.
Precisely.
Yeah.
But there are significant drawbacks.
Okay, what are they?
Well, first off, Division A will almost certainly make a loss on paper because this $18 doesn't cover any of its fixed costs. That's incredibly demotivating for Division A's manager and team.
Yeah, I could see that.
Performance measurement gets distorted too. Division A looks bad, while Division B gets an easy ride with artificially low costs, potentially inflating its apparent profitability or cash inflows.
Doesn't sound fair.
It's often not perceived as fair. Also, there's little incentive for Division A to be efficient with its variable costs if they know they'll always be covered. Any inefficiencies just get passed straight through to Division B. Yeah.
How do companies deal with that?
Well, one recommendation if you are using variable cost is to use standard marginal cost.
Standard cost, meaning what it should cost.
Yes, what it should cost under efficient conditions, not necessarily what it did cost. That way, any variances, efficiencies or inefficiencies, stay within the division that caused them. Division A benefits from being efficient and suffers if it's inefficient.
Okay, that makes more sense. What other practical methods are there?
Other common ones include using full cost or full cost plus a markup, variable cost plus a markup, or sometimes even market price.
Let's take full cost. That includes fixed costs too, right? So maybe $30 in our example.
Right. If Division A's full cost, including a share of fixed overheads, was $30, this is slightly more satisfactory for Division A, as it can at least aim to break even or cover all its costs.
Sounds better for Division A, but what's the catch?
The big drawback is that it can easily lead to dysfunctional decisions for the group.
How so?
Let's use that $30 full cost transfer price. Imagine the final market price for the end product fell to, say, $35.
Okay.
Division B looks at its costs. $30 for the transfer price, plus its own $10 marginal cost. That's $40 total.
But the selling price is only $35.
So Division B says, no way, I lose $5 on every unit. I'm not buying from Division A at that price. They decide not to trade.
But wait, from the group perspective, the actual marginal cost is still just $18 plus $10, which is $28.
Exactly. The group could still make a positive contribution of $7, $35 selling price, minus $28 group marginal cost. So the group wants the trade to happen, but Division B, acting rationally based on the $30 transfer price, refuses.
So the profit motivations clash, and the group loses out. What happens then? Does head office have to step in?
Often, yes. Head office might instruct them to trade anyway, for the good of the group, but then you've just destroyed that divisional autonomy we wanted to preserve.
And probably made the Division B manager pretty unhappy about being forced to make a loss.
Absolutely. And those cost plus approaches, full cost plus a markup or variable cost plus a markup, they make things even more motivating for Division A by giving it a profit.
But they still have that same risk.
They still run the same risk of those dysfunctional decisions as the final selling price falls, because the transfer price is even higher.
What about using market price if there's an external market for the component?
Yeah, that's another option. If there's a reliable external market price for that intermediate product, the pro is that it should give both divisions a chance to make profits, assuming they're efficient. It also has the important advantage of providing an objective price, often seen as fair.
And you can compare performance to outside firms.
Yes, allows for better performance comparison, helps with investment decisions, but it still runs that same risk of encouraging dysfunctional decisions if the final selling price falls towards the group's actual marginal cost.
So it seems like all these practical methods have this built-in flaw.
The common drawback, really, for all methods other than pure variable cost is that they make fixed costs and potentially profits from markups appear as marginal cost to the receiving division.
Right. Division B sees the $30 full cost or maybe $35 full cost plus as its variable input cost.
Exactly. Division B, therefore, has the wrong data, the wrong cost information to enable it to make good economic decisions for the group, even if you want it to. So yes, they all pose a risk of dysfunctional decisions unless you also impose some kind of upper limit, like that net marginal revenue we talked about earlier.
So these practical methods simplify things, but come with real challenges. Are there any, clever accounting solutions to try and fix this? Or what happens when there is a real active external market for this intermediate product that the divisions could actually use?
Well, there's some variations on the variable cost method that try to be clever, though they tend to be more complicated to run.
Like what?
One is called variable cost plus lump sum. The idea is transfers happen at variable cost, say $18, so Division B gets the right cost signal for its day-to-day decisions.
Okay.
But then periodically, maybe monthly or quarterly, a separate lump sum transfer is made from Division B to Division A. This lump sum is calculated to cover Division A's fixed costs and give it a share of the profit.
So B gets the right marginal cost, but A still gets compensated fairly overall.
That's the idea. The pros are that Division B has the correct cumulative variable cost data for its decisions, and performance measurement can be seen as fairer. The con, it's definitely more complicated to administer.
Okay.
Any others? Another approach is dual pricing.
Dual pricing, two prices for the same thing.
Sort of. The transferring division, Division A, records the transfer out at, say, cost plus a markup, maybe even market price if available. So it records a profit.
Okay, good for Division A's motivation.
But the receiving division, Division B, records the transfer in at just the variable cost, say $18.
So B gets the correct economic data for decisions.
Exactly. Pros. Division A can make a motivating profit. Division B has good economic data about the cumulative group variable costs. Cons.
Let me guess. Complexity.
Big time. The divisional current accounts won't agree internally. You'll have these fictitious interdivisional profits building up that need complicated period-end adjustments to reconcile everything and eliminate them from the group accounts. It gets a bit fiddly.
Right. So these solutions exist but aren't simple fixes. Now, what about that external market point? How does that change the calculation?
Okay, yeah, external markets for the intermediate product really change the game because now we have to consider opportunity costs, what the divisions could do outside the company.
Right.
Let's go back to our basic example. Div A variable costs $18, full cost $30. Let's say the internal transfer price is currently $50. Div B adds $10 cost, sells final product for $90.
Okay.
Now, scenario one. What if this intermediate component could be bought or sold on an external market for $40?
Okay, $40 is the market price.
So Division A looks at this. Sell internally for $50 or externally for $40. They prefer the internal $50 transfer.
Makes sense.
Division B looked at it. Buy internally for $50 or externally for $40. They'd much rather buy externally for $40.
So they disagree. What's best for the group?
The group's perspective. Buying externally means incurring a $40 marginal cost. Producing internally in Division A only costs $18 marginal cost.
So internal production is much cheaper for the group.
Right. So the transfer price, if we want the trade to happen internally, which is best for the group, must now compete with that external price. It can be no higher than the external purchase price of $40.
So the external market pulls the maximum price down from $80 to $40.
Exactly. The maximum is now the lower of the net marginal revenue, $80, and the external price, $40. So the workable range is now $18 minimum Div A marginal cost, up to $40 maximum external price.
So the external price acts as a new powerful constraint.
Precisely. Now, scenario two. What if the intermediate product could be bought or sold externally for $60.
Okay, higher market price now.
Division B looks at it. Buy internally for $50 or externally for $60. They prefer the internal $50 transfer.
Easy choice for B.
Division A looks at it. Sell internally for $50 or externally for $60. They'd much rather sell externally for $60.
Okay, so now A wants out, B wants in. What about the group?
Again, the group perspective. Buying externally costs $60 marginal. Internal production costs just $18 marginal. So internal is still better for the group.
But Division A won't want to supply internally for $50 if they can get $60 outside, right? Especially if they have limited capacity.
Exactly. If Division A sells outside, Division B might be forced to buy externally at $60, which is bad for the group. $60 cost versus $18 internal cost. So to encourage Division A to supply internally, the transfer price must compensate them for that lost opportunity.
The opportunity to sell for $60 outside.
Right. The minimum transfer price Division A should accept is now its marginal cost, $18, plus the contribution it loses by not selling externally. That lost contribution is $60 external price minus $18 internal variable cost, which is $42.
So the minimum is $18 plus $42 becomes $60.
Exactly. The minimum transfer price becomes $60. It has to be at least as good as the outside selling price to make Division A indifferent between selling inside or outside. The maximum is still $80, Div B's net marginal revenue. So the range is now $60 to $80.
Wow. So the external market price can set the floor or the ceiling.
Correct. This leads us to a kind of revised economic transfer price rule that incorporates these external market realities.
Okay, what's the revised rule?
The minimum price set by the transferring division A must be greater than or equal to its marginal cost plus any lost contribution. That's the opportunity cost from not selling externally.
Got it. Marginal cost plus opportunity cost.
And the maximum price set by the receiving division, B, must be less than or equal to the lower of two things: its own net marginal revenue and the external purchase price, if it could buy the component outside.
Minimum is marginal cost plus lost contribution. Maximum is the lower of net marginal revenue or external buy-in price.
That's the essence of it.
This particular point is quite illuminating. You can really see how complex this gets, balancing internal efficiency, external market opportunities, trying to guide divisions to make decisions that are best for the whole company, even when it might not immediately seem like the best deal for their individual bottom line.
It's a constant balancing act.
We've certainly covered a lot today. You might have initially thought transfer prices were just minor internal accounting adjustments, simple debits and credits that just balanced out in the end.
Yeah, on the surface, maybe. But as we've explored, that's only looking at it at the most elementary level.
Yeah.
If you connect this to the bigger picture, transfer prices are absolutely vital.
Vital how?
They profoundly impact motivation, decision-making, how performance is measured, investment choices, everything within a business. They are genuinely the factors which can often separate successful businesses from unsuccessful ones.
It's clear then this internal price isn't just some accounting detail, it's a strategic weapon, really. It can guide or maybe even misguide a company's whole path. What stands out most to you from this deep dive into transfer pricing?
For me, it's that intersection of economics, psychology, and strategy. It highlights how seemingly objective numbers can be anything but, and how crucial it is to understand the behavioral consequences of the systems we design. Get it wrong, and you can inadvertently demotivate your best people or make terrible strategic bets. Get it right, and it aligns everyone towards the common goal. It's powerful stuff.
Powerful stuff indeed. So the next time you hear about a company's internal restructuring, maybe a division making an unexpected decision, or even a big shift in global tax strategy, take a moment. Consider how an invisible number, a transfer price, might have played a hidden but absolutely crucial role in that outcome. It's truly fascinating how a single figure can hold so much power,